In the next few years, most investors will be blindsided by a ghost. Not supernatural, mathematical. A pattern etched into the economy's DNA, older than any headline, stronger than any single policy move. While the world watches every Fed line and market tick, something deeper is stirring. We're drowning in noise and missing the signal. That signal lives in the forgotten cycles, structural rhythms of credit, innovation, and human behavior. They don't predict every wiggle. They map the tides beneath the waves. One farmer saw it first, Samuel Benner. In the 1870s, he charted booms and busts from pig iron prices and revealed a repeating pulse. Today, we go beyond Benner, applying that logic to compute, data, and AI. Our model points to a collision window, 2026 to 2030. Unprecedented credit, exponential AI disruption, and immutable historical math converge into a single systemic pressure point, the Shatter Zone. In this video, we'll unpack each cycle, translate 19th century insights to the semiconductor age, and give you a 2027 red flag checklist, plus the specific months our simulation highlights for potential panic. Quick question before we dive in. Do you believe markets follow hidden math or pure chaos? Comment math if you see the code, chaos if you don't. Subscribe, and let's navigate the Shatter Zone together. Look closely at the last 150 years of economic history. What do you see? A series of random, unpredictable shocks? A chaotic storm of human greed and fear, where lightning can strike anywhere, anytime? That's what most people believe. That's what the headlines tell us every single day. Chaos. But what if that's not the whole story? What if, hidden beneath the noise of the news cycle, there's a rhythm? A predictable pulse. A kind of ghost math that has been mapping out the booms and busts of our economy for centuries with terrifying accuracy. What if I told you that the same blueprint that predicted the Great Depression, the dot-com bust, and the 2008 financial crisis is now pointing to a very specific window of time between 2026 and 2032 as the next great economic reset? And what if it told us exactly when the panic is likely to hit and when the generational buying opportunity will arrive? It sounds impossible, right? Especially now, in a world of artificial intelligence, cryptocurrencies, and instant global communication. How could a dusty old formula created over a century ago possibly apply to our complex digital world? That's the critical question. Is it all just chaos, or is there a code? To find the answer, we don't need to look at a supercomputer. We need to go back to a simple farmer from Ohio. To understand where we are today, in February 2026, and where we are going, we have to start with a pig farmer named Samuel Benner. In 1875, Benner was a successful man. He had a prosperous farm, a thriving business, and a secure future. Then came the panic of 1873. It was a brutal, out-of-nowhere financial storm that swept across the nation, and it wiped him out. Completely. He lost everything. Now, most people in that situation would have been broken by it. They would have blamed bad luck, corrupt bankers, or the government. But Benner was different. He was a farmer. He understood that nature wasn't random. It operated in seasons, in cycles. He wondered if the economy did too. So, in the ruin of his finances, he embarked on a remarkable quest. He stopped reading the news and started looking at numbers. He gathered decades of data on prices, not for stocks, which were still a niche asset, but for the real-world economy. The price of corn, cotton, and most famously, pig iron. He was looking for a pattern, and he found one. What Benner discovered was revolutionary. He realized the economy doesn't move in a straight line of endless progress. It's not a random walk either. Instead, he saw it as a series of massive, overlapping gears, turning with a predictable cyclical rhythm. He published his findings in a book in 1875, titled Benner's Prophecies of Future Ups and Downs in Prices. It was, in essence, the first farmer's almanac for the financial world. His theory was simple, elegant, and divided the economic climate into three distinct types of years, which he labeled A, B, and C. First, you have the A years. These are the years of panic. Benner identified a recurring pattern of major financial panics that seemed to follow a 16, 18, and then 20-year sequence before repeating. These are the moments when the system breaks. confidence evaporates, credit freezes, and markets crash. It's a time of forced liquidation, where assets are sold not at the price you want, but at the price you can get. It's a painful but necessary cleansing of the system's excesses. Think of it as the brutal winter storm that snaps the dead branches off the trees. Next are the B years. These are the years of prosperity. Benner called these the good times, when prices for assets are high and climbing. This is the economic summer. Confidence is high, business is booming, and everyone feels like a genius. According to Benner's cycle, these are the best years to sell your assets, to take profits, and to build up cash reserves. It's the time to harvest what you've grown, because he knew that summer doesn't last forever. The cycle dictates that after a period of high prices, a downturn is inevitable. Finally, and most importantly for long-term investors, are the C years. Benner called these hard times. These are the years that follow the panic and the subsequent downturn. They represent the long trough of the cycle, a period that can last for years. During these C years, prices are low, businesses struggle, unemployment is high, and the general mood is one of pessimism. The world feels broken. But for Benner, this wasn't a time for despair. It was the time of maximum opportunity. This is the economic spring, the period when the seeds of the next great fortunes are sown. It's when everything is cheap, when no one wants to buy, and when you can acquire quality assets for pennies on the dollar. Now, a theory is one thing, but what about the track record? This is where Benner's work goes from being a historical curiosity to a stunningly relevant tool. Using his simple ABC cycle of years, Benner's chart, drawn by hand in 1875, predicted the panic of 1929, decades before the ticker tape was even a common feature on Wall Street. His cycles pointed to the downturns around the turn of the 20th century, the post-war boom, and the stagflation of the 1970s. And yes, his cycle model flagged the period around 2007-2008 as a time of high prices and a prime window to sell before a major panic. But Benner also identified something bigger. By combining these smaller cycles, he uncovered a 54-year great cycle of panics and depressions. And most importantly for us, right here, right now, his work identifies the period from roughly 2028 to the early 2030s as a generational hard times floor, a C period. The kind of deep structural trough that only comes along once or twice in a person's lifetime. But this brings us back to our critical question. Benner was looking at the heartbeat of the physical world, the cycles of harvests and industrial production. His pig iron was a literal ton of metal sitting in a foundry. In 2026, our economy's pig iron isn't sitting in a foundry, it's sitting in a data center. Our most valuable commodities are not corn and cotton, but compute power, bandwidth, and intellectual property. The engine of our economy is now driven by silicon, not steel. So how can this old map possibly guide us through this new territory? The answer is that the underlying drivers of these cycles, human nature, credit, and energy, haven't changed at all. The physical world still underpins the digital one. To understand why Benner's hard times are about to slam into the digital age with unprecedented force, we have to look at an even larger, more powerful set of cycles. We have to look at the great seasons that govern the rise and fall of entire technological civilizations. If Benner is the heartbeat, Nikolai Kondratiev is the climate. Writing in the 1920s, he identified long waves of 50 to 60 years driven by technological revolutions. The sixth wave. Every wave has a winter. It's the period of creative destruction where old debt is burned away to make room for new growth. We are currently in the sixth Kondratiev Winter. Historical context. The last time we saw a Benner hard times floor overlap with a Kondratiev Winter was the 1930s. We've spent the last 15 years trying to print our way out of this winter, but history shows you can't skip a season. You can only delay it. And as of February 2026, the delay is over. Kondratiev Winters aren't endless doom. They clear debt so real growth can restart. In the sixth wave, the stress shows up as tight credit, failing zombie firms, and capital rushing toward truly productive tech. When Benner's C floor overlaps this winter, lows stretch longer but rebounds compound faster. In plain English, patience now, aggression later. This brings us to right now, February 2026. This is what John Wade, in 1833, called the commercial peak. Wade noticed that the seventh year after a crisis is when speculation becomes a disease. We are 7 years out from the 2019 liquidity crisis. On the surface, everything looks fine. But Wade's math warns us that this is the false summit. The smart money is already moving to the exits because they see the juggler friction coming in 2027. Juggler friction is the mid-cycle credit squeeze. Profits look fine, but refinancing turns expensive and scarce. That's why the false summit feels safe right before liquidity thins. In 2026, treat calm prices as exit noise and prepare your 2027 checklist. 2027 is the transition year. It's when the gears start to grind. Use this checklist to watch the Shatter Zone live. 1. The Wade divergence. Watch if banks stop lending while the Fed claims everything is stable. 2. The AI ROI plateau. Look for tech giants to report massive spending with zero new profit. 3. The Dr. Copper signal. If copper crashes while gold spikes, the physical world has entered the freeze. 4. The Sismondi Shift. Massive layoffs in untouchable white-collar jobs. 5. The Jevons energy spike. When the cost to power AI makes home electricity unaffordable. This all leads to the panic bullseye, September-October 2028. This is the 155-year harmonic of the 1873 panic that Benner lived through. In 1873, it was railroads. In 2028, it's the AI credit bubble. When the market realizes that the AI revolution is a 20-year project, but the debt used to build it is due now, the juggler credit cycle will liquidate everything. This isn't just a crash, it's the great reset of the K winter. After the acute panic of 2028, the global economy doesn't just bounce back. Instead, it limps into a strange and punishing new phase we call the stagflation trap. This is the period from roughly 2029 to 2030, and it's where the cycle's logic gets truly counterintuitive. To understand it, we need to look at two thinkers from the 19th century whose ideas are about to become startlingly relevant: Jean-Charles Léonard de Sismondi and William Stanley Jevons. Their theories, when combined, paint a vivid picture of the economic landscape we're heading into. First, let's talk about Sismondi and his theory of underconsumption. Writing during the First Industrial Revolution, he noticed a fundamental problem. As machines get better and better at producing goods, they also replace the human workers who are supposed to buy those goods. The result? A crisis of overproduction. Factories churn out more than a population with stagnant or falling wages can possibly afford. Sound familiar? In our modern context, AI and automation are the ultimate production machines. They can generate software, designs, and digital services at near zero marginal cost. This leads to a deflationary spiral in the digital world. Your streaming subscriptions, software tools, and AI assistants will become incredibly cheap, maybe even free. But this digital abundance comes at a cost. It hollows out the middle-class jobs that once powered consumer demand for everything else. Now, let's add the second ingredient: Jevons paradox. In 1865, William Jevons observed that when technological improvements make the use of a resource more efficient, we don't end up using less of that resource. We end up using much more. His example was coal. As steam engines became more efficient, the demand for coal didn't drop. It exploded, because now it was economical to use steam engines for everything. Today, the resource isn't coal, it's energy and computational power. AI models are becoming incredibly efficient. But are we using less energy? No. We're building bigger models and more data centers, driving global energy demand to unprecedented highs. This efficiency paradox creates intense inflationary pressure on the physical world. The electricity to power your home, the fuel to transport your food, the raw materials needed for batteries and infrastructure, All of it becomes more expensive as it's devoured by the digital economy. So, what's the result when you combine Sismondi's underconsumption with Jevons' paradox? You get the stag-deflation trap. Your digital life becomes virtually free, an endless buffet of content and services. But your physical life, food, energy, housing, transportation, becomes a luxury. The economy stagnates because widespread demand has collapsed, yet the cost of essential physical goods keeps rising. This is the final, grinding, hard times trough that Samuel Benner's cycles predicted for the year 2032. It's not a crash, it's a slow, painful squeeze. It's the economic floor of the entire multi-decade cycle. But for those who understand the math, the floor is not an end. It's a foundation. This brings us to the great opportunity, the 2032 Phoenix phase. A phoenix, as we know, rises from the ashes. In 2032, while the mainstream world is still reeling from the squeeze, a historic liquidation sale will be underway. The assets that will power the next boom cycle, the one that runs into the 2040s, will be available for cents on the dollar. Why? Because the owners of that critical infrastructure will be desperate for cash. They'll be forced to sell valuable, productive assets to cover debts from a world that no longer exists. Those who followed the map, preserved their capital, and understood the cycles will be the buyers. They won't be buying speculative tech stocks or chasing fleeting trends. They will be buying the boring, essential, and deeply undervalued infrastructure of the future. What's on this shopping list? Think about what becomes priceless during the stag-deflation trap. First, energy infrastructure, solar, battery storage, and the grids that connect them. Second, computational infrastructure, the data centers and chip fabrication plants that the AI revolution cannot live without. Third, the picks and shovels, the companies that supply the raw materials and machinery for this new build-out. And finally, efficiency itself, distressed logistics, automated warehousing, and new models for efficient housing. This isn't about gambling, it's about strategic acquisition. It's about recognizing that when the world is drowning in digital noise, the value migrates to the tangible things that power it all. History is a circle, a rhythm of chaos and renewal. The key is not to be trapped by the chaos, but to master the math that governs it. If you want to see our full analysis of the 2028 panic window that precedes this phase, comment cycle below and hit that subscribe button. Let's navigate the Shatter Zone and be ready for the rise of the Phoenix together.